in my last 3 lectures, what we did, we learned about how to calculate cost of debt, cost of preferred stock, and cost of equity, like common stock. But before doing that, let me discuss something very, very important with you. Okay, so can you see my screen right now, Usman?
Yes, sir.
Okay.
Yes, sir.
So this is attendance that I downloaded last time in my interactive session. So as you can see, all students, it has a timestamp. So whenever they joined, it has a timestamp. Whenever they left, it has a timestamp. Okay. 2 of the students, I already talked to Ibrahim. He was late. He joined actually the meeting at 12:30. He was supposed to be at 12. Okay. Similarly, Temur, he joined, I think, 45 minutes late, like 44 minutes. Okay. So yes, it will mark your attendance, but it tells me what time did the student actually join the meeting and what time did they leave. So please be careful. I'll ask you questions during the meeting just to make sure that whatever I'm teaching you, that you're actually, you're learning it. It should be a 2-way communication rather than, let's say, me talking all the time. If you have any questions, anything, raise your hand, and then I'll be happy to answer your questions. Okay, before moving to our today's lecture, let me give you a quick solution for our assignment. Okay. So can you see my screen right now? Whiteboard.
Sir, अभी loading. अभी load हो रहा है, sir. But
Okay.
Yes, sir.
Okay, let me actually share another one. Okay. Can you see the screen?
No, sir.
Whiteboard?
Sir, अब आ गया.
Okay,
show हो गया, sir.
Okay, with some writing. Okay, so if you remember, the first question was payback period for undergraduate degree. So I took this example. One of the students said that he or she will need 3,030,000 rupees as total investment. And that includes actually the tuition fees, living expenses, and any other expenses. Then what he or she said that they're expecting actually 70,000 rupees per month. So 840,000 per year. So if you plot it actually on the timeline, at time 0, what they did, what he or she did, they invested 3,030,000 rupees initially, and then he or she is expecting to make 840,000 rupees each year. Of course, this is a very, very strong assumption because in the job market, normally what you do, you get increments, right? Sometimes I would say like after 2 or 3 years, some graduate students, they actually change their jobs. So working with the same salary, I think it's a very, very, I would say, conservative and strong assumption. But anyways, I'll go with the numbers, okay? So whenever you're calculating payback period, the first thing you need to do is calculate the cumulative cash flows. So in the first method, we are only concerned about the cash inflows.
Excuse me, sir.
Yes, go ahead, Usman.
Sir?
No, sir, it wasn't me.
Okay. So in the first year, the student is expecting to make $840,000. In the first 2 years, they are hoping to make, he or she is hoping to make 1,680,000 rupees. cumulative. So 840 plus 840, okay? And in the first 3 years, of course, 2.5 million, okay? And then the fourth year, almost 3.36 million. So as you can see, in the first 3 years, he or she is making 2.5 million. And then in the fourth year, he or she is making 3,360,000. So as you can see, the student is able to recover his or her investment between year number 3 and year number 4. So whenever you're calculating payback period, the first task is actually to find the range, okay? Range. Of course, you can go with the formula, but I'm giving you actually the logic behind it. So the range is between 3 and 4 years. Between, okay? So payback period is equal to 3 plus. So the student recovered 2,520,000 rupees in 3 years. How much remaining is going into the fourth year? Of course, you have to calculate the difference between this money and the initial investment, okay? So that difference is, let's see, 3,300 minus 2,520, okay? So I have to still recover this much money in my fourth year. And in fourth year, how much am I getting in total? 840,000, okay? So whatever you calculate, this will be 3 point something, like some fraction, okay? I do not have calculator on me right now, so you can calculate it yourself. So it's 3 point something. 3 point something, okay? Now, some of the students, and as I always, emphasize on the fact, this, please develop number sense. And from that, what I really meant, that some of the students, for example, one student said that the payback period for his or her degree is 76 years. Okay, one student said 39 years. So let's say if I'm calculating payback period, okay, 76, what does it tell you? It tells you that, okay, you will spend 76 years of your life to actually get your investment back. Does it make sense? Does it make sense?
No,
of
sir.
course it doesn't make sense. Yes. Okay, even 39, it doesn't make any sense. Okay, now some of the students, what they did for this fraction, it should be a fraction. This fraction should be always less than 1. So it should be a fraction less than 1. Okay, always. Okay, if it's more than 1, it means that you made a mistake. Okay, so that is something I wanted to emphasize. Number one, develop number sense. Sometimes it doesn't click in your mind that, okay, 76 years, no, it's not possible. Probably I made a mistake somewhere. Okay, 39 years, no, it doesn't make sense. Normally degrees, as I said probably in one of my lectures, the payback period is normally between 2 and 3 years. In this case, I think in your case, since it's a 4 years degree, I think it's like close to between 3 and 4. This is the general trend. So most of the students got this question right, which is a great sign. I'm very happy about it. And most of them, they came up with a range between 3 and 4. So this is like kind of a payback period that you should be looking at for your undergraduate degree. Okay, now for question number 2, okay, let me share that screen with you now.
Excuse me, sir.
Yes, go ahead.
सर मुझे कॉल आई है अभी मेरे नाना की तबीयत बहुत सीरियस है and I have to go, sir.
I'm so sorry for that. Yeah, yeah, please do that. Yeah.
Okay, sir.
Okay, okay, all the best. Yeah. Okay, so can you see my Microsoft Excel?
Yes, sir.
Okay, perfect. So question number 2 was, number 1, you have to calculate IRR. Super simple, okay? So the formula that we are using is equal IRR, and then you have to give actually the range of the cash flows, and then you have to give a guess number. Guess number can be anything. It can be 0.15. Let's say if you're thinking that okay, it's close to 15%. Doesn't make a difference. It only gives a reference point to the computer, and then computer actually through iterative process, it zero ends on the rate at which the NPV is 0. So IRR is technically the internal rate of return at which the net present value of a certain project is 0. Okay. Then what we did, we plotted actually the NPV value of okay, let me go back. So what we did actually, we calculated, we actually plotted the NPV profile. Okay, so my Excel is unfortunately acting funny again. So save. Let me open it again. I apologize for that. All right, so I'm almost ready. Okay, can you see my screen now?
Yes, sir. It's visible.
Yes, sir.
Perfect. So this is the NPV profile of project A and project B. So what I can tell you, actually, I saw some of the assignments from the students. Some of them are very comfortable with Microsoft, let's say Word, Excel, and some of them, they have, I think, below acceptable level of proficiency in Microsoft Excel and Microsoft Word. As a business graduate, I cannot emphasize more. The industry is actually expecting you to have advanced skills in Microsoft Office. If your skills are weak, I would seriously suggest it is as important as your any other course. So please develop those skills. Like for example, I was dealing with some assignments where the formatting was like horrible. Even the graph that did not actually label the x-axis and the y-axis, you have to do everything properly. Okay, anyways, so this is the NPV profile of project A and project B. As you can see, the crossover rate, which is like the Fisher rate of intersection, it's around 28%, as you can see from this point. IRR for project B is around here. This is the point where the NPV is 0, okay? And then for project A, it's around 35%. Okay, so your first task was actually to, number 1, calculate IRR. So we did that in Excel. It was super easy. Your second task was actually to visually identify the Fisher rate of intersection, so which is this one, and then IRR. IRR is the rate at which NPV is 0. So for project number B, it's this point, and for project number A, it's this point. So graphically, yes, you can actually identify those points. But at the same time, you can also calculate it. We did that. We used actually the solver add-in with Microsoft Excel, and then we calculated the internal rate of return, okay, at which NPV of both the projects is exactly the same. Again, graphically, it's like that point at which both the projects intersect. Now, the last part of question number 2 was which project would you accept and which assumptions, okay? So there is no one answer for it. As you can see from the NPV profile, and plotting the NPV profile serves exactly the same purpose. As you can see, if the discount rate is less than crossover rate, let's call it crossover rate. Okay, which one? This is more feasible. Why? Because here below the crossover rate, it is creating a larger NPV for project B compared to project A. But let's say if rate is greater than the crossover rate, okay, so in the first one, project B was acceptable, and in this situation, project A. Okay, so there is no one answer for it. Okay, so you have to justify your answer, and this is the justification. If rate is less than the crossover rate, you accept one project, but if the rate is more than the crossover rate, of course you accept the other project. And what is the assumption? Number one assumption is that we are assuming that both the projects have the same level of risk. That's why we are using the same discount rate. Okay, so if I'm using the same discount rates, so if you see, I have evaluated, let's say, both projects at 5%, then at 10%, then at 15%, then at 20%. Okay, so I have evaluated both projects at one rate, which means same risk. Okay, now this is a very strong assumption. Okay, there will be hardly any projects which have the same level of risk. Okay, so one of the assumptions in this analysis is same risk. Okay, and the other assumption is, of course, there is no capital rationing. As I told you in one of my lectures, if there is no capital limit, I mean, you have, let's say, for example, you have unlimited level of capital, right? So your project ranking will look like, let's say, for example, let's say under no limitation on capital. Let's say if the project ranking is A, B, and C, but let's say if you put a restriction that, okay, you cannot invest more than, let's say, a certain level of amount, like you have a capital, so you cap your capital investment. From capping the capital investment means that actually you're putting a limit, right? And if I then rank the projects, it may, let's say, look like this, BCA, right? So in this particular question, of course, one of the assumptions was that there is same risk, and the other assumption is that there is no capital rationing, because we did not put any limit on the capital. And as we see in one of my lectures, that if you put restrictions on the capital, then of course it changes sometimes, not always, but sometimes the whole story. It changes actually the project ranking. Okay, I think this is enough for the project. And I'll go back to my today's lecture. The other thing that I can tell you, in one of my videos, I would say like 80%, I cover the assignment. Yesterday, I was just checking states on that video. Only 12 students watched that video until now. And out of those 12, probably I watched it myself probably 2 or 3 times. So maybe 8 or 9 students effectively watched that video. And unfortunately, it doesn't help. Okay. So in today's lecture, what we will do, we will actually use all the information that we calculated in my previous lectures. And then we will calculate weighted average cost of capital. I go back to this slide all the time. And the reason I go back to this slide is not all liabilities actually qualify for calculating weighted average cost of capital. It's only that part of liability which has a certain cost attached to it. So for example, your notes payable and long-term debt, okay? So your total debt qualifies for, of course, calculating cost of capital. Then you have common stock and retained earnings. Both common stock, retained earnings, and by the way, preferred stock, they make actually the equity part of your capital. Okay, and as you remember from one of my slides, we were considering a very, very simple example. There was a company in which the investor supplied capital was $100 million. Okay, $35 million was long-term debt. 15 million was actually preferred stock, and common stock equity was 50 million. These are the weights. How do we calculate the weights? Of course, individual components by total. So this is total. Okay. In one of my lectures, I calculated the cost of the long-term the cost of debt, and that was actually after-tax cost of debt. Then I calculated cost of preferred stock, and then I calculated in my last lecture cost of common equity. And we used actually 3 different approaches: constant growth, phase growth, and then of course we used what's it called? So that was like through dividend. So one was dividend discount model, the other one was using actually CAPM, and the other one was using debt plus some premium. So from my previous slides, we calculated the cost of debt is 6%, 9% per preferred stock, and common stock equity was 13%. So if I apply those weightages, okay, the weighted average cost of capital is 9.95%. And how do we calculate it? It's super simple. What do? You multiply individual component of the stock. So what are the components mainly? Component is again debt, okay, preferred stock, and then you have common stock. Okay, so you multiply each component by its weight. So if you remember, debt had 13% contribution in the total capital, and then 15% was preferred stock, and then 50% was common stock. And this is the way we calculate it. We multiply, of course, individual rate by its weight, and then we add it up. Now, this is something super important to remember. And if you remember, good for you. And if you don't remember, too bad. Okay? If you see here, although it was a simple example, but the cost, stock, is greater than cost of debt. Okay? So if we compare this 13% with 6%, okay, cost of stock is greater than cost of debt. So what the book says that, let's say if we are evaluating individual components of the capital, okay, so individually, let's say debt, preferred and common. And let's say if you calculate something where common stock cost is less than cost of debt, okay, you should, it's a sign of something that you did something wrong. Okay, because most of the time, 99.9% of the time, cost of stock should be more than cost of debt. If it turns out that the cost of stock is less than the cost of debt, you made a mistake. Go back. Because as I told you in one of my lectures, that the cost of common equity is more because that one, the cash flows are uncertain for common stock. And number two, they have a residual claim on company's asset. Residual claim on company's asset. So if you combine those points, it's more risky. It makes this component more risky compared to debt. So that is something that you should take away from this slide, that the cost of stock ideally should be more than the cost of debt. If it's otherwise, you made a mistake. Okay, so WACC. Why was WACC important? Let me go back to this slide. WACC is important because it gives you a single rate which satisfies expectations of all, let me call them, let's say, bondholders, preferred stockholders, and let's say capital providers. Okay, so for example, long-term debt, the debt holders were expecting, let's say, 6% return, preferred stock 9%, and 13% for common stock equity holders. Of course, you can use individual rates, but that's not practical. If you are evaluating the value of a company, you need a single rate. So let's say if a company's weighted average cost of capital is 9.95%, it means that this rate individually satisfies the bondholders, the preferred stockholders, and the common stockholders. Okay, because this 9.95 is calculated based on these three components. Okay, so WACC is important because it gives you a single rate which satisfies the expectations of all capital providers. But of course, there are certain limitations for WACC. And what is the first limitation? The weighting system itself, it doesn't take into account the marginal capital costs. So for example, let's say company A, okay, debt, and let's say I'm talking about stocks. So it is like preferred stock plus common stock. So suppose debt is 40% and stock is 60%. Okay. Now this is a typical capital structure of a company: 40% debt and stocks 60%. But let's say if you're considering a project and you need 100, it's a big project, you need $100 million. Of course, you have to raise capital for it. So if you raise capital, this is additional capital. This is additional, or you can call it marginal capital. Okay. So if you raise the additional capital in the same proportion, so for example, you raise $40 million from debt and $60 million from stocks. by issuing stocks. Then of course, whatever you calculated is a WACC, you can use it. You can use WACC in this situation, because by raising $40 million out of 100, you are not disturbing the initial proportions. You are working with the same proportions. And if you are working with the same proportions, please keep this in mind, take a note. If you are working with the same proportions, or in other words, if you are raising additional capital in the same proportions, it doesn't affect the financial risk of that company. I repeat, because this is important. If you raise the additional capital or the marginal capital in the same proportion, it doesn't change or it doesn't affect the financial risk of that company, okay? Which means that you can use the same WACC that you already calculated, okay? Because if you are calculating WACC, of course, you are not taking the additional capital in consideration, because this is something for future. This is not something for now, this is something for future, okay? But investments, they call it lumpy. Investments are normally lumpy, right? So this particular project, what they do, the company will normally go, let's say, to a bank and will raise, let's say, $100 million from a bank, or let's say $100 million through bond issue, okay? So they normally do not go into, let's say, two different sources of capital. They normally go for one, okay? That's why it's called lumpy. But in the long run, what financial managers do, like for example, if they raise all $100 million, let's say from bonds, the next project, let's say again $100 million, they normally issue stocks, okay? Just to keep that proportion intact. And why are they are so worried, not worried, but like, let's say, cognizant about that capital structure? Because capital structure defines the financial risk of a company. And finance managers, what they think that, okay, for their company, a typical optimal capital structure is, let's say, 40-60, they try to maintain that structure, okay? So marginal capital cost is actually one of the limitations. And why is it a limitation? Because companies generate that capital in lump sum, they're lumpy, okay? So if they're lumpy, it means that it disturbs the capital structure of that company. It disturbs, in other words, the ratio between debt and stocks. And if it disturbs that ratio, it means that the risk is changed now. So the risk profile changed for that company. So whenever the risk profile changes, of course, your WACC also changes. If WACC changes, it means if you're using the WACC, which you already calculated for the existing structure, it will not be good. And it will not be good in two ways. Okay? So for example, let's say, if by raising the capital, if the risk goes down, because I said the risk profile changes, so it may increase or it may go down. So for example, if the risk goes down, it means that technically we should use a lower WACC. A lower WACC means that a project will be accepted for a certain, let's say, present values that otherwise it would have been rejected. So I'm sorry if I'm making it a little bit confusing for you, okay? If the marginal capital changes the risk profile, okay, and as a result, the risk goes down, it means the WACC technically, let me write it with new, the new WACC should also go down, okay? If I do not make this adjustment, what will happen? If no adjustment is made. No adjustment. If no adjustment is made. So what will happen? We will probably end up rejecting good projects. So we will end up rejecting those projects which may be actually beneficial for the company. But let's say if the additional capital actually raises the risk of a company, okay? So it means that WACC new should also increase. And again, if I do not make any adjustment, I run a risk of accepting bad projects. Because the WACC that I'll be using will be lower, okay? And with lower WACCs, I may accept a project which on a higher WACC will not be acceptable. Okay, so there are two risks. If the risk becomes low because of additional capital, okay, and I do not make adjustment, I may reject a good project. But let's say if the risk increases, of course, I have to make an adjustment in WACC. If I do not make that adjustment, I may accept a project which is bad. So these are the risks. Okay, flotation costs. So of course, if you are raising additional capital, it has certain costs associated with it. These costs may be, let's say, underwriting costs, legal costs, listing costs, and printing fees, something else. So whenever you are raising additional capital, it has certain flotation. So let's say if you are floating new shares in the market, which means you're issuing new stocks to the market, okay? It's also called floating the stocks, okay? It has certain costs associated with it. So of course you have to adjust for those costs. And how do you do that? You make adjustment in two different ways. You either adjust the initial cash outlay or you adjust the discount rate. And I'll show you how to do that. It's very simple. So if you remember from the NPV, what is NPV? We discount all cash inflows, okay? And then we subtract the initial cash outlay. So that was NPV in a typical situation when there is no flotation cost. But if there is flotation cost, what you do, you add flotation cost to your initial cash outlay, because this one is like an expense. Okay, so it's a cash outflow. So what you do, you add it to your initial cash outflow, okay? And you subtract it from the discounted cash flows, and that gives you net present value. So whenever there is a flotation cost, what is the impact generally? It reduces your NPV. And of course it should reduce your NPV. The reason is it's like an expense. It's an additional cost of raising capital. So it should reduce your NPV. Why is the adjustment important? It's important because if the flotation costs are significant, which means, let's say, $50,000, okay? So if you're considering, let's say, a $200,000 capital, let's say, to be raised for a certain project, and let's say if the flotation cost, I'm sure it's not 50,000, but let's say $10,000, okay? It's a significant amount. If you do not take into account those flotation costs, of course, you may accept a project which should be otherwise rejected. Okay, so if you do not take into account, and the reason I'm writing it for you, it's important, take into account flotation cost, okay, think it should be A here. Okay. You may accept bad project. You may accept bad project. And of course, accepting bad project it's not good. You may lose money. Okay. There's another way. So flotation cost, what we did, actually, we made an initial adjustment here, but there is another way. Another way is actually to increase the WACC by a little bit. So suppose WACC, here there is no flotation cost, no flotation cost, okay? You add little bit cost for, let's say, flotation cost. Okay, so let's say if in case of no flotation cost, if the WACC is 15%, okay. So in order to account for flotation cost, you change it to, let's say, 15.3%. And where is this 0.3% coming from? It's actually to account for flotation cost, okay. And this 0.3 technical increase, so 0.3 increase takes care of flotation cost. Okay, so you can make actually adjustment in two different ways. One, you either subtract it from, add it to your initial cash outlay. So you add it to initial cash outlay, or you make an adjustment, and it is always, okay? It is always upward adjustment, so increases the WACC. So it's an upward adjustment. So 15 will change to, let's say, 15.3%, okay? And let's say 10% will change to, let's say, 5%, okay? So this adjustment is always upward. And if I make an upward adjustment, what does it do? If you see my previous slide, so this is like WACC here, okay? So if I increase this K, okay, what it does, it decreases actually NPV. Is this clear, Osman?
Yes, sir.
Okay, perfect. Okay, today's last topic, economic value added. This is a very, very important topic. It's a measure actually of business performance. So there are two. One is called accounting value, and the other one is economic value. Okay. Both of them actually, they measure business performance, but accounting value does not take into account certain costs. Okay. And that's one of the limitations. So accounting value is whatever is appearing on your books. Okay. Economic value added is another way of measuring that firms are earning returns on their invested capital that exceed their cost of capital. Specific measures developed by this company, okay, Stern Stewart and Company, in late 1980s. And it's a very, very popular concept now. And I'll tell you in the next slide that why is such an important and powerful tool. So if you remember a typical balance sheet, income statement, we have one item, it's called EBIT. It's earning before interest and taxes. And then we have another item, it's called EAT, which is earning after taxes. This is also called net income. Okay. So in this income, of course, you take out, you subtract your interest expense, and then you also subtract taxes. Now, if you see this interest expense is actually cost of debt, in other words. Okay, this is your cost of debt. So this is cost of one part of your capital. But as you can see, that earning after taxes does not take into account, does not take into account the cost of equity capital. Okay, so in order to calculate the economic value added, what you do, this is another term which is very, very commonly used. It's called NOPAT, net operating profit after taxes. So it's EAT, or net income, is exactly the same thing, minus cost of capital multiplied by capital employed. And cost of capital, it's actually equity capital. Equity capital. Okay, preferred stock and common stock and retained earnings. Okay, and this is also equity part of the capital. Okay, why did we take only equity capital? Because NOPAT, as I expressed here, it already takes into account the cost of debt. Because EAT, it's a refined, it's a net income, and we have already taken out the interest expense. So the cost of debt has already been taken care of. The only cost that is not being taken care of is actually cost of capital, equity capital. So for example, if a profit and loss or income statement of a company tells you that the company made $10 million in net income, okay, and if I ask you, are you happy with this income? Okay, so this is not a very simple answer, because the first thing you should ask yourself, is this $10 million adding any economic value to the company? So the first thing you should think, is this $10 million adding any economic value to the company? And from that, what I mean, what if a situation where the cost of equity, the cost of equity capital, which is this part, is, let's say, $12 million. Okay, so let's say if the cost of capital of that particular company is $12 million, it means that the economic value added is equal to minus 2 million. Okay, how did I do that? 10 minus 12. Okay, now what does this mean? It means that the company actually lost $2 million. The value actually shrunk. So value of the company went down by $2 million. And why $2 million? Because that equity capital, those individuals could have invested that money in a similar company, and that could have earned $12 million. Do you see my point, Osman?
Yes, sir.
Yes. So earning after taxes or net income, it may or it may not add economic value to the company. Okay. And how does this economic value translates? It translates into, so economic, I would say positive economic value added. How does it translate into companies? It increases price of the share or share price. Okay, negative EVA, and I'm talking about theoretically, it should decrease stock price. Because what it does, it means that the value of the company actually shrunk. It went down, although it made a profit. But if I take out actually the cost of equity capital, it's negative. So positive economic value added, it adds value to the company, and negative, actually, it decreases the value of that company. So whenever, let's say, if you're looking into income statement, the first thing you should look at whether it is adding any economic value to the company. Because as an investor, let's say if I invested, for example, let's say $100 million in this particular company, okay? And my expectation is to make 12% return, okay, from this investment. Then of course you are expecting $12 million. I can easily invest this much money in a similar company and can make 12%. Okay, so if the company is making only $10 million, it means that the company is not going in the right direction. More precisely, it's actually losing its value. So anything more than 12, it's adding value. Anything less than 12 million, it is actually losing value. Some companies, as part of their, it's like, it's one of the most important or powerful tool actually for the management to make certain decisions. Like for example, Infosys Technologies, it's an Indian company. It's one of the giants actually, tech company. And I borrowed this example from the book. They always calculate economic value added, okay? And the way they do it, of course, you need net operating profit after taxes. So in this case, it was 34.9 billion, because this money, this amount is already in millions. 34.9 billion rupees, Indian rupees, okay? And the average cost of capital for this company is 14.97%. And the capital employed is 94.7 billion. So if I multiply the capital employed by cost of capital, it's 13,690. So the economic value added is actually $21 billion. So what it really means that this particular company, for that particular year, it added 21 billions in economic value to the company, which should translate into higher share price. It means that they are doing well. But let's say if the net operating profit was only, let's say, $6 billion, then of course they would have lost close to $7.6 billion in value. And that one also shows in decreased share price. So I thank you very much for your attention, and I will open the floor now for any questions. If you have any questions, please raise your hand and I'll unmute you, or maybe you can unmute yourself and then we can start discussion. Okay, so I will take that as a no. This is a very, very important topic. Some of the concepts are a little bit technical, in my opinion, for undergraduate students. So please go through the material, watch my video, especially the part where I explained the limitations of WACC. That is a very, very important topic. Please go through it. Watch my previous videos. The best thing about online lectures is, of course, you can go back to the material and watch it again. And you can watch it anytime. The worst part is, if you do not watch it, of course, you wouldn't understand my next lecture. So as I told you in my very, very first lecture, that you have to show exemplary discipline. If you do not watch videos on time, unfortunately, it will hamper your learning process. So please do that. It doesn't take more than 30 or 40 minutes. And I also understand that, okay, this is not the only subject that you're probably learning online, but assuming, let's say, if you have 5 subjects, okay, In total, then you have 15 lectures in a week. 15 lectures, and let's say on average 1 hour. So 15 hours commitment in 5 days. It's 3 hours commitment in a day. It's not that we are asking for too much. So I will stop here. And my expectation is that you will watch this video again and again. And of course, if you have questions, you have my email number. So I wish you all the best. I'll stop recording here.